Let me ask you a quick question. Is your business really making a profit? You might look at your bank account, see a bunch of cash in there, and think you're doing great. But does that actually mean your business is succeeding? Too often, people think accounting is just this boring chore you're forced to do for taxes once a year. But actually, scratch that. It's not. It is absolutely crucial. It's the ultimate decision-making tool for your success. Honestly, if you don't understand the numbers, you're just flying blind.
Hello, and welcome to this explainer. I am so excited to guide you through what is essentially the secret language of the business world, financial accounting. We're going to decode this language together. By the end of this, you are going to have an exciting new way to look at everyday entrepreneurship, and you'll be totally empowered to make smarter, data-driven decisions. All right, let's dive right into this. So here is our roadmap for today. Section 1, the secret language of business. Section 2, core accounting terms. Section 3, balancing the basic accounting equation. Section 4, assumptions that shape accounting. Section 5, key principles of financial statements. And finally, Section 6, accounting and real action. Section 1, the secret language of business. Translating numbers into strategy. Now, what's really fascinating is just how many different groups rely on this exact same language. Accounting isn't just about jotting down numbers. It's a highly structured information system. Think about a small bakery owner. They need it to see if their monthly sales are actually covering rent, wages, and flour. Then you have managers who use it to decide if they can afford to, say, open a brand new branch. Investors read this language to hunt for solid returns, while banks use it to figure out if you can actually pay back a loan. And yeah, even the government uses it for economic planning and taxes. It's literally the universal translator of all business activity. Section 2, core accounting terms, the core vocabulary. Okay, to speak this language, we need to know the words, right? First up, we have assets. Simply put, assets are the valuable resources your business owns or controls. And why do you own them? Because they're going to provide you with future economic benefits. Think back to that bakery. Their ovens, the cash in their register, those heavy bags of flour in the back room, these are all assets because they actively help generate income down the road. Next up, we have liabilities. If assets are what you own, liabilities are what you owe. These are the obligations or debts that you owe to outside parties. So if you bought that flour for your bakery on credit and you haven't paid the supplier yet, or maybe you took out a massive bank loan to buy your ovens, yep, those are liabilities. You have to settle them in the future. Now, accountants absolutely love to organize things by time, which leads us to how we categorize our assets. We split them into current and non-current. Current assets are strictly short-term. We're talking things like cash or raw ingredients that you expect to use up or turn into cash within a single year. Non-current assets? Those are your long-term investments. Heavy machinery, delivery vehicles, buildings, or the land your shop sits on. You're planning to use these for many, many years to come. And that brings us to equity. Honestly, this is kind of my favorite concept. Equity is the owner's true slice of the pie. It's your remaining interest in the business once you take all your total assets and subtract every single one of your liabilities. Basically, it represents the net capital, the true wealth that the owner actually holds in the business. Section 3, balancing the basic accounting equation, the golden rule. So, now that we have the vocabulary down, let's look at the grammar. Assets equal liabilities plus equity. This right here is the unbreakable law of the business universe. What this equation tells us is actually quite profound. Every single asset your business owns must be funded in one of two ways. It was either funded by outside debt, your liabilities, or it was funded by the owner's own capital, your equity. It always balances, no exceptions. Let's ground this theory in reality, okay? Let's introduce Chick Hannah, who is starting her very own home-based cake business. On day one, she takes 10,000 ringgit of her own personal savings and invests it right into the business. Watch exactly what happens to the equation here. Her cash, which is an asset, increases by 10,000 ringgit. And because she funded it herself, her capital, which falls under equity, also increases by 10,000 ringgit. Assets equal equity. The equation balances perfectly. Now watch what happens next. Chick Hannah needs an oven to bake, right? So she buys one for 3,000 ringgit using cash. Her cash asset immediately goes down by 3,000. But she just gained a brand new asset, equipment, which goes up by 3,000. So her total assets didn't actually change in value, they just changed form. Liabilities and equity weren't touched at all. Like I said, the golden equation never breaks.
Section 4, Assumptions that shape accounting. The rules of the game.
If the equation is our grammar, these assumptions are the cultural rules of the game that make sure everybody plays fair. The first rule is the separate entity assumption. And listen to me carefully here. Never, ever use company funds to buy your personal household groceries. The business is considered a completely separate entity from the owner. If you buy a personal phone with your own money, it doesn't exist in the business records. Mixing them up completely ruins your ability to evaluate the true performance of your business, so keep them separated.
Next up is the accrual assumption. This is how proper businesses operate. Now, in a cash basis system, you only record things when cash literally changes hands. But real accounting uses the accrual basis. This means you recognize expenses and revenues when they actually occur. So, if you use a ton of electricity to bake cakes in March, you record that electricity expense in March, even if you don't actually pay the utility bill until April. It paints a much more accurate picture of your monthly performance.
Section 5. Key Principles of Financial Statements. Guiding Principles.
These assumptions build the foundation for the guiding principles that accountants use to report fairly. Take this number, 500,000 ringgit. Let's say a business buys a building for exactly this amount. Under the historical cost principle, that building is recorded at exactly what it cost, 500,000. Even if the local real estate market totally booms and 5 years later the building is worth 700,000, the accounting record strictly sticks to the original historical cost. Why? Because it's objective and it's backed up by a solid receipt.
There are a few other vital principles we rely on too. The matching principle says if you earn revenue this month, you absolutely must match the cost required to make that revenue in the exact same month. Then there's the consistency principle, which says pick a method and stick to it year after year so we can actually compare your growth fairly. And the full disclosure principle? That one is huge. You must disclose any vital information, like say a massive pending lawsuit, so that investors are never kept in the dark about risks.
Section 6. Accounting in Real Action, bringing it all together with Seek HANA.
All right, let's bring all of this together. The vocabulary, the equation, the principles, and look at the ongoing story of Sikhama's business. Say she buys raw materials on credit. Boom. Her inventory asset goes up by 1,000 and her accounts payable liability goes up by 1,000. It balances. Next, she sells those baked cakes for 2,500 in cash. Her cash asset jumps up and her revenue goes up, which ultimately increases her equity. Finally, she pays a 300 ringgit electric bill. Her cash drops by 300 and she records an expense, which decreases her equity. As you can see, every single transaction weaves perfectly into her overall financial story, all without ever breaking that golden rule.
And where does this entire story end up? It culminates in the 4 main financial statements. First, the income statement reveals her true profit or loss. Then the statement of financial position, which people often call the balance sheet, shows her assets, liabilities, and equity on one specific date. The cash flow statement tracks the actual physical cash moving in and out. And finally, the statement of changes in equity shows exactly how our capital has grown over time. Together, these reports reveal the true, undeniable health of any business. So as we wrap up, I really want to leave you with a provocative thought. If you were to start your dream business tomorrow, what would be your main assets? And what liabilities would you have to take on just to get it off the ground? Try looking at your ideas through this powerful new lens of accounting. It's really not just numbers. It is the fundamental blueprint of your future success. Thank you so much for joining me in this explainer, and keep exploring.